What's up, everybody? Michael Silva here to do some technical analysis on the S&P 500. In today's video, we are going to be zooming out to a larger time frame to answer the question, when will I buy back into the stock market? Let's get into it. All right, welcome back. Now, before we can answer the question, when is a good time to buy back in the stock market, or when am I going to be buying back into the stock market, I want to go ahead and tell you or show you a little bit more about the psychology of a market. Now, we're not going to spend too much time on this because chances are you've already seen this chart, and this is known as the Wall Street cheat sheet. But what I really want you to pay attention to on this psychology of the market here is this line right here called the mean. Now, a lot of the times people completely ignore the mean, and then they're just kind of paying attention to everything around it, what it says. And as you know, this looks very similar to what's currently going on in the market. However, what I'm going to show you today is going to be pretty interesting stuff because the mean may potentially have changed. All right, so what do I mean by the mean has potentially changed? Well, basically, really quick, what the mean is, it's like, think of it as just the normal trend. And when something stretches way out, like a rubber band, it usually comes back to normal. The mean is basically, you know, if it's a straight line like this, it might extend over and then come back, and it might overextend and then come back, but always it follows the mean. Now, there's things that could potentially happen in an economy or in a stock market to change the mean from being down here to potentially being up here, and that's what I want to point out. So look at this channel as of right now where the S&P 500 has been in for quite literally, I mean, it's always been in there up until October of 2016 when it broke out. If I scroll all the way back, you can look at 1971. It's always been within this channel. Now, that's why I want to call this bottom line right here the mean. Okay, this is the normal area. It's the trend line that the S&P 500 follows. And as you can see throughout this course of history, all the way up to about 1994, I'd say 1995, it started moving upwards. Now, as you know, there was a lot of technological development around this time known as the tech boom. And what you saw was a run up from this point, and a lot of money started flowing into the market. A lot of new companies started hitting the market, and you started seeing it come up and up and up to this trend line or resistance line, I'll just call it, up here at the 1500 level. And then what happened? Well, look at the date. It's 2000. This is when the tech bubble popped. Okay, there was a lot of excitement running up to it, and boom, it came back down. And it retested the mean, right? It came back down to the bottom of that trend line, which we're calling the mean. Now, what I'd like to point out is as time went by further and further, you notice it came back up to this peak up here around the $1,500 level. Okay, so it came down to the mean, and then it started working itself back up, and look at the date, October 2007. Now, as you can see, during this time, this is known as, you know, the real estate bubble. This is when asset prices were really, really inflated at a particular time. And what's very similar to this run up and this pull back and then bump up and then all of a sudden pull back below the mean. This is what I want you to pay attention to, okay? It pulled all the way back below the mean, but then it, you know, it's like a rubber band. Like I said, it might go under, but then it shoots itself back up. It follows the mean. Now, if I go ahead and flip to the other psychology of the markets chart, you'll notice it started right here, right? Back in the early, basically after, I think it was 2004, 2003, you started to see the takeoff. You might have seen a little bit of a pullback, which is known as a bear trap. And then you started seeing it move back up. And this is where, you know, it started gaining media attention. Everybody on the news started talking about, you know, real estate prices. You can never lose money. And then you got enthusiastic people. And then you really started seeing greed pour into the markets and delusion. And then all of a sudden, boom, it hits, and it hits very fast. Okay, and then you get a little bit of a bump, and then boom. Now, back to the mean. Look at this dip. It's a little dip like this, okay? You couldn't couldn't make a better chart. I mean, I didn't make this chart, but you couldn't make a better chart or see a better chart that represents this better than the trend line that I'm showing you. And this right here is the despair. Well, you have it capitulated, and then you have a lot of despair in this area, and then a return to the mean. So as you can see, the capitulation happened right around this point in 2008, and then this is where it created a lot of the despair, and then the revert to the mean. Now, what took place to make the price go from complete despair underneath the mean to up in this area by late 2000, mid 2015? Well, what was taking place in this range was when we lowered interest rates to near zero and also started quantitative easing 1, 2, 3, and 4. So by pumping liquidity in the markets, what that does is it inflates asset prices. So we started feeling the wealth effect. We started seeing markets move up. Okay, it's paper wealth. We looked rich on paper. We started seeing real estate prices start to head back up as the years continued, and that's because of low interest rates, not because of savings, not because of productivity, but it's because of the Federal Reserve stepping into the markets and saving us from basically a complete collapse. Okay, so as time went on, blah, 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 blah. Now I'm just going to keep on fast forwarding over here. So now, moving forward a little bit, we actually ended up breaking through this resistance line. It struggled over here, right, in 2015, all the way to about the end of 2016. Now, what happened in 2016 or November 2016? Well, the president changed, right? We had President Donald Trump step in. Now, what I find so interesting about when he came to office, and then all of a sudden it's above this new trend line, is previous to him taking office, his campaign was ran on the topic of this is the biggest bubble economy. Okay, and I believe that he was extremely right, and I still do to this point about it being a bubble. Now, from this date forward, it became all of a sudden the strongest economy in the world, the greatest economy in the world, the most thriving economy in the world. So from this point, we started seeing it move up, and then that 2018, late 2018 pullback happened. Now, this has to do with a couple of things, right? So the Federal Reserve during this time started lifting interest rates up, right, to taper the balance sheet. If you understand the markets, you know that they cannot do that, especially when we fast forward till today. They started it a little bit. Okay, actually, you know what? Let me point up the asset chart right now, and you can see that line right there kind of start tapering down. That was during this time. That was when they started trying to reduce the balance sheet. Well, the market took this big dump, right? It tanked down, and then what did the Federal Reserve started doing from this point forward? Well, it started doing the repurchase agreements. So the repos, it started entering into the market with the repos. Okay, so the market started pumping up to this point right here, 33.81, and then boom, it happens, right? The market takes the staircases up, but it takes the elevator down. Now, why am I just reiterating stuff that you probably have already seen or already know? It's to paint the picture of the potential of a new mean. So, is this down here when I should be buying back into stocks, or is it not? Are we going to get a retest of this, or is this line, this upper trend line, now the new mean? Now, it's interesting to think that this potentially could be the new mean because of the fact how I said in 2008, when it broke through the mean, the Federal Reserve really started stepping in, okay, with quantitative easing 1, 2, 3, and then it brought all the way up right here. We talked about that, and then look at this. It came below this trend line. Some might say it was a retest. I would say that this was the retest, but the Fed stepped in, right? And then it came down, and then what did the Federal Reserve do? The largest amount of quantitative easing on QE4 ever in history. So it really took its toll right here at this point. They stepped into the markets and started pushing it back up. So my question is this: is this the new mean? was this the area of despair in the markets? Or is this actually a bull trap where it can head up and then pull back? Now that's the interesting part. Now what I want you to pay close attention to is that when this pulled back, it kind of jumped up and then all of a sudden this big hit and moved to new highs, and Fed really stepped in right here. Okay, so it was resistance here and then started moving up and then pulled back down. Could have been a bear trap. I would consider this a bear trap. And then we started getting a lot more excitement into the markets. Okay, so let me go back to the psychology sheet to really show you what this looks like. So if the mean had changed, that would imply that in 2016, we were in the takeoff phase, and then that pullback that I talked about in 2018 was the first sell-off, known as the bear trap. Okay, it almost hit the new mean. Remember? I said it almost hit the new mean. And then it started moving up, and then you have the president coming out. It's the greatest economy ever, and we started hitting this new paradigm. That was the high of the S&P 500. And then what took place? We saw that big pullback. Okay, remember I was looking at the weekly candles. Let me show you again. We saw the pullback, but then look at the high of this wick is up here. So you would say that it came down, moved up, and then started heading down again. Now, let me go back to the psychology chart. Pull back up to return to normal, right? The bull trap. And then boom, you got fear, capitulation, and then back to the mean. And this is the despair area. You see what I'm saying? How the potential of the mean has changed. Now, pay close attention to this despair area. Let's go back to the chart. Here is the low of March 2020. Is this the despair area? That's the question. So is this the low? Well, you can ask yourself this. What did the Federal Reserve do? The Fed stepped in and started pumping incredible amounts of money into the system, more than ever before. Quantitative 4, it's basically unlimited powers, unlimited supply of money, unlimited liquidity. What can that potentially do to the markets? Well, in the despair, so it came down all the way to here, it reverted to the mean and started moving up pretty significantly again. If I go back to the psychology chart, it dips down and returns to the mean, but what happens really after this point, it returning to the mean? Now, it's already way above the mean. So that's back to the beginning again, the takeoff phase. So are we going back into a takeoff phase, and potentially we'll see a bear trap take place? Meaning, if the price comes up and it comes to retest this, will it be a bear trap to start moving forward to make new highs? Well, I believe in 1987, it didn't. On the 1987 crash, it came down, it did this bear rally, and then came back to test the low, and then moved back higher. So it's going to be interesting to see. Now, I think by looking at the current candles and the current chart that we might be due for a pullback or a retest. But the thing is, the Federal Reserve stepped in here with so much money. And if we go back to 2008, during this phase, right, the despair phase, it did come back up around the mean, and it retested it, and it retested the mean again. However, the quantitative easing being used in this round is significantly more than what it used in 2008. So did the Fed save the economy, or did the Fed just bail out the entire market in the entire US, all the companies? Is this going to bring us to new highs? Is this the new mean? So, I mean, it's a question worth asking, but do you understand the psychology chart and how I match it in here? So a lot of people might say, no, it can easily revert to this mean, and it very well may. Now, I want to point out one last thing. I want to go ahead and pull up the retracement tool. Notice how on the retracement tool, it just now broke above the 61% level. For many weeks now, it has been between the 50 and 60, but now we got a close again, a full candle, daily candle close in this zone. Now it's obviously running into a lot of resistance in this 3,000 to 3,300 level range. So this right here is the range to keep a very close eye on. That's the bear's fortress, okay? So, but if you look at where this could potentially drop if it breaks through its low here, look at that. it's basically sitting on this trend line. So the question remains, will the price come in, get rejected by the 3,000 and make itself slowly come down or potentially fall harder through that and retest this trend line, which is known as the original mean? Or is this the new mean? Will we just see the price potentially, head lower, maybe even retest it, but then start moving higher because of all the liquidity that the Federal Reserve is doing? This would be known as a market melt up. However, you can just look at it as a new mean, and then the market psychology chart still rings true, still holds true. And it's going to be very interesting to see what happens when the economy opens back up. Like I said, we have in other videos, we have so many job losses. So many small businesses are struggling. It's very interesting times. I was watching an earlier video today on the stimulus checks and how they were used and how fast they were being used. It's astonishing. I also hear that most people don't have enough money to just handle a $400 emergency. So it's crazy to think that the market can reach these new highs, but yet most people don't have a job. So my question, the question that I originally asked is, when will I enter back in the stock market? Well, as you know, I'm not in it right now, but I'd be interested to start scaling in small, in this area, but I'm not going to move my 401k back into the stock market all at once until probably it's more closer to these levels down here. Now, will it ever reach there? Maybe, maybe not, but I will dollar cost average because I do feel like a pullback is imminent. That will come and happen. If it doesn't, does that mean I will only stay in cash? No, I feel like the safest bet right now is in gold, is in silver, is in mining stock companies. So that is where I'm hedging my bet against or with. So basically betting with the Fed with gold, because I do think that the quantitative easing will never stop. The balance sheet will never shrink. It's just impossible. They've already tried and they failed. Will we get negative interest rates? I don't know. Maybe. So yeah. That's my thought process. Hope you enjoyed this S&P 500 technical analysis video for today. That's all I got for you. I'll see you later.